Okay, we're going to take a look at how to interpret non-tax incentive analysis in Impact Dashboard. So um, I've got a scenario here that I've already kind of filled out everything. The last little piece is going to be to put in this incentive analysis and then kind of talk through how that comes together. So first thing I'll point out here before we look at the actual inputs is that this project includes 100 jobs phased in over 3 years, kind of 40, 40, 20, as we see there. And then we can also see through everything else that's been entered, this project is generating net benefits for the city of $1.7 million over 10 years. That's our estimate of net benefits, $1.7 million in total. Um, so to kind of analyze this non-tax incentive as we've been talking about it, we're going to go to the public support tab. And again, we're focused on the city in this case. The example we're going to look at is for the city. So I'm going to scroll past all of these in these kind of tax incentives. So we've got a property tax abatement that we could do, or sales taxes of different types. And then we get down here to the bottom, and we've got this. It's a little bit of a catch-all for us. It's just generically called a non-tax incentive. It could really represent a number of different things, kind of cash out of pocket, if it's going to be like, in this case, we're thinking of it as an infrastructure grant. But in other cases, it might be the, say a job grant, or if you are maybe providing the company a piece of land, and that land was valued at, let's say, $100,000. You could think of that $100,000 as a non-tax incentive and compare that in the same way with this analysis. And so a key part of this analysis is really that we're thinking of the incentive as an investment. And so if we're investing, and again, let's say $500,000 for our example here, the return on that investment is going to be thought of as that net benefit that the city receives over the time period. So in this case, we had a $1.7 million net benefit over 10 years for the city. That's our return on investment. So what we're going to be doing is kind of comparing this non-tax incentive, the amount of $500,000, to our net benefits. And so to do that, we've got a couple different options on our incentive approach, and we'll talk about that. But the easiest one, and the one I'm going to start with, is the incentive amount. So let me put in $500,000. I'm going to say this is all paid in year one. If we wanted to spread it out, we certainly could. But as we do that, put in 500,000 in year one, we get this box that pops up, and we can see, oh, that's $500,000. We actually get a total incentive gray line that kind of goes across here, kind of as a reference point, showing us where $500,000 is all the way for the 10 years. And the interesting thing is you can kind of see those two lines intersect. And so what are those two lines again? So the orange line is our net benefits, kind of a cumulative net benefit over time. So it's we can see it intersecting with the other line, which is our total incentive. That's $500,000. And so where that intersects, what that's finding is the point at which the city will have collected enough in net benefits to cover the value of this incentive. And so we can see it's somewhere between year 2 and 3. And actually, if we look up here in this analysis, it's calculated for us. That's actually the payback period. So the point at which those two lines intersect, that's that same payback period. So it's the point at which the project will generate enough net benefits to pay back the value of the incentive. So that's the one criteria here, the one incentive calculation that we make. The other that we can see here is rate of return. And so this is where we're looking at an average annual rate of return over the period. In this case, the project is generating $1.7 million over 10 years. And so if we took kind of the average of that, well, maybe that's about 170,000, let's call it. And that's on an investment of 500,000, so that's about 35,000, or excuse me, 35% as an average annual rate of return. And then the the per job metric there is just dividing the total incentive, in this case 500,000, by the total number of jobs. In our case, we had 100 jobs, makes the math pretty easy there. Now, uh, we don't have to plug it in. And so maybe you run this and this looks good, but maybe you want to look at some other options, and you could say, well, actually, um, let's do like a $6,000, but we're going to do it per job. Maybe that's the other option. So it's not an infrastructure grant paid out in the first year. We actually just want to give them $6,000 for every job that they add as they add it. So what we can do, well, I just selected the incentive per job approach. And then I have this input that lets me put in an incentive per job. So I'll put in $6,000. And we had, again, remember we had 100 jobs, and they were actually phased in over 3 years. And so that's what's happening here. We see our boxes popping up in 3 different years. But the total amount is 600,000 because we had 100 jobs times 6,000. And we actually, if you remember, we had like 40 jobs in year was 1 and 2, and then 20 jobs in year 3. And now in this case, we can see that intersection is almost right there on year 3. So that's pretty cool. We can look up here and we can see, oh, yeah, it is. It's 3.1 year payback period. So if you remember, we were at like $500,000. We had a 2.5 year payback period. In this case, when we stretch it up to 600,000, the payback period extends out a little bit longer to 3.1 years. Now, the rate of return has kind of recalculated as well. Kind of our investment amount now has gone up to $600,000, so that's changed as well. Now, what we could do, let's just kind of think of another situation where maybe 3 years is too long for a payback period. So maybe they want to say, look, we'll do maybe something a little bit more than 500,000, but we can't go all the way out. And, our rules are, maybe internally our ED organization says, hey, we got to get paid back in 3 years. So if that were the case, we just want to find what incentive would be associated with a payback period of exactly 3 years. We can come in again to our incentive approach, choose payback period in years. Then we can change this to 3 years. And now we kind of knew what was going to happen. It was going to land somewhere between 600,000 and 500,000, but we didn't know the exact amount. And in this case, we can see that exact amount gets calculated for us of $580,000. We can see it's a little bit less than $6,000 per job, and then our rate of return is a little bit higher than the previous iteration as well. Now, you can also target, say, a rate of return. So if you needed an average annual rate of return of, say, 50%, we can do that as well, and that'll be a little bit less. We can see $340,000 roughly to get that rate of return of 50%, and pretty short payback period in that case as well. That is pretty much everything I wanted to show regarding how to kind of look at that incentive analysis and how we kind of calculate these different metrics.